Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is a very, very special guest, Andrew Axelrod. He is a global macro commentator and he is featured on Zero Hedge and Bitcoin Magazine as well. Welcome, Andrew.
Hi, Ivan. Thank you so much for having me on your channel. I just want to say you've got one of the best Twitter accounts. I follow you. Follow you. Anybody listening, I recommend they follow as well. Really good stuff.
Yeah, huge pleasure having you on Wall Street Silver, Andrew. And there's so much chaos in the markets right now, and the Federal Reserve have basically trapped themselves. It seems to be a trap of their own making. How bad is Jerome Powell's dilemma right now, Andrew, and how will it affect gold and silver?
Yeah, it's pretty wild what's going on right now. I mean, you talk to pretty veteran participants in the industry, and they've seen it all. They've sat in risk shares for 30 years. They've seen the SNL crisis. They've seen what the tech crunch. They saw what happened in 2008. Whatever they saw what happened during COVID, and they're saying they've never seen markets trade this way. And I think it is a little special because you can tell by sort of the reaction of you mentioned Jay Powell. Yellen's another one. They're going out there on the media circuit. They're trying to assuage fears. They're saying everything's fine, but obviously nothing's fine. I mean, it
Nothing's
doesn't look.
fine.
Yeah, if you just look at during the last few weeks, you look at all these bank failures. I mean, we're already at 2008 levels. Just the last four big ones that popped: First Republic, Signature, SVB. I'm not even counting Credit Suisse, but these alone, in terms of assets that almost went pop, if it weren't for the bailouts, it's 2008 levels. So the more J Powell comes out, the more Yellen come out and say, the banking system is stable, everything's fine. That I think that worries people more
Right.
than sort of calms them down. So yeah, we are living in sort of special times. I think another thing to highlight is, it's only twice before in history have we had both equity and bond markets collapse by over 20%. The first time that happened was in 1931. And then within like 24 months, you had obviously one of the biggest defaults in US history. You had the Executive Order 6102, which was the gold confiscations.
Wow.
And which, in other words, it's a major default. And once that was gone, printing went into hyperdrive. And the other time that happened was in 1971. That was the other year that bonds and equities both collapsed simultaneously, because usually they offset each other. But
Mhm.
that was the one other time that they both collapsed together. And then of course you had the Nixon shock, the gold window that closed the second time. This wasn't for U.S. citizens. This was for the international markets, where sovereigns couldn't redeem their dollars for gold anymore. And again, you had massive printing. And the third time it happened was last year, where again, bonds and equities collapsed by 20%. And I think we're
Wow.
starting to see sort of the after effects of this. So there's a lot of people out there saying that these initial bank collapses, that's sort of just a little taste of what's to come.
So do you think it's very similar, like what will happen in the 30s, how bonds and equities collapsed? Now it happened last year. And after that, you said it was 20 some months, and then you've seen a huge default. Do you think we could see a same default? And what kind of catastrophe will that bring into the markets?
Yeah, I mean, if who knows? I don't have a crystal ball, but
Yeah.
if history's any indication, I mean, you would say yes. So again, within 24 months, within 2 years, you saw a major default, and who knows what this looks like this time around. I think it was Luke Roman. He had a very astute point. He was basically saying that looking at this as a banking crisis is sort of the wrong lens to view this through. That what it really is camouflage for a balance sheet capacity issue for U.S. Treasuries, because essentially, rewinding 2 years, you had record low rates. I think it was that sitting in 2020, and in
Mhm.
2020 was sitting, federal funds rate was sitting at 25 basis points. And you know what? In the private market, like nobody would be lending out for 10 years at these rates. So it was very much the banking system's sort of covert mandate to find balance sheet capacity for these U.S. Treasuries, and they based on Fed guidance and based on favorable accounting rules held to maturity, all of this, they did what they were told. Essentially, they loaded up on Treasuries,
Mhm.
and they got rug pulled, obviously. So when the Fed hiked rates at a record pace, going from, again, 2020 was 25 basis points, went up a little bit, but then within a year, we went from 1 3/4 up to whatever it is now, between 5 and 5 1/4. they basically ruined the banking system's business model, right? Because they're borrowing short and they're lending long, and if you're inverting the yield curve, where now short term interest is here,
Right.
and the long term is down here. That the banking business model doesn't work, and they're no longer able to fulfill that mandate of essentially shoveling endless cash into this Ponzi. So now the race is on to find more balance sheet capacity, and it's a difficult task, especially with international appetite drying up. So I mean, China stopped buying back in 2013. Japan, although with the U.S.'s blessing, because they have their own issues, they're focusing their firing power on their own debt load, but they're no
Right.
longer able to absorb the U.S. government's spending appetite. So the question really is, is this going to go from a so-called banking crisis to like a full-on sovereign credit crisis, or even a default? Which, again, if history is any indication, we should be seeing that within the next 2 years.
With all this chaos in the market, where are you putting your money right now? Where are you finding safety right now, Andrew?
Yeah, I mean, there's a lot of ways to go about this. I know, obviously, Wall Street Silver, you guys are big into silver.
Yeah.
Gold's another good one, but I think, anything that's outside of the system is probably, at least to have a little exposure to that isn't the worst idea. This isn't financial advice because I'm saying it, obviously, but just personally speaking, yeah, I think
Right.
having a little bit of exposure outside of the system is probably a good idea. Me personally, I like Bitcoin. I do daily commentary on the financial markets and what's going on in global macro, and
Mhm.
usually I do that through a Bitcoin lens.
Absolutely. And you've been talking recently about central bank digital currencies in a recent interview and how it could be rolled out. Do you think a central bank digital currency will be rolled out in our lifetime, and will it be just accepted?
Yeah, I definitely think so. I mean, potentially in June. Forget our lifetime. It could be within the next few months. They're going to be
Wow.
testing the waters. I mean, with banks blowing up, you would think the Fed would be, pretty busy, which they obviously are. But
Right.
despite all this turmoil, they found time in their busy schedule to speed up the timeline for their CBD for their, well, they call it Fed now, which is this payment service. But a lot of people are calling it sort of a precursor to an eventual CBDC, and that's going to go live presumably in June is sort of what's expected. So yeah, I definitely think they're going to be testing the waters, and it goes, and I don't think it's a coincidence that this is lining up with the banking crisis, because we're just talking about the banking system's unofficial mandate to sort of find buyers for
Right.
U.S. Treasuries, and since it's obvious they no longer can do that, they're not in a position to do it. You now sort of need to centralize power into sort of one ledger or one balance sheet that the Fed can control, and that's another word for CBDC. So a good way of doing that is getting a lock on the banking system, getting them all onto one ledger, which is what Fed now could be, which obviously gives the government and the Fed a whole new set of tools to manage this. And I think there's we're going to see this play out. I mean, they have a lot of runway, so this could
Right.
take years, potentially decades to play out. I mean, if you just look out across the world, you see central bank's balance sheet to GDP, and the U.S. is actually quite low. It's in the low 30s. You compare that to some countries in Europe where it's above 120%. You
Right.
look at China, where I think it's 213%. So they have a lot of runway. As you're seeing appetite abroad dry up, as you're seeing banks sort of having a lot of difficulty to park that debt into U.S. Treasuries, the Fed has a lot of leeway to monetize it. It's just a question of how they're going to do it, and potentially, Fed now or a CBDC would be a good way of doing it.
The BIS, the Bank of International Settlements, they're announcing their own CBDC coming out. The program, I think, is called Icebreaker, and more countries are transitioning to this. Andrew, do you think in any way people will find it just dangerous on the privacy side and not accept it? What do you think on that aspect?
Yeah, I'm a little dubious on that. So, I mean, unfortunately, I think privacy is super important, but it doesn't seem to rank very highly in people's sort of
Right.
hierarchy of importance. So, you just look at social media, for example. I mean, after
Right.
Snowden and all these leaks, it's become really obvious that you don't have privacy online. So all that data is being sucked up, it's being collected, it's being analyzed, and still, like, it's not stopping anybody. Like, you can count on one hand people that are paying for even a VPN. I don't think
Right.
that data is safe necessarily. It's really just another honeypot to get sucked up. But even so, very few people use VPNs. Everybody, including my aunt, our grandparents, they're all on social media. Nobody cares. I think it's very much going to be the same with CBDCs potentially, especially if things start getting dicey. So, you have a few more shocks in the banking system. People feel their deposits are in, their life savings are in danger. It's not going
Right.
to take a lot for people to sort of put aside any privacy concerns and just buy into it. I mean, honestly, all it would take is, redeem your $100 CBDC, got to sign up here. I
Yeah, that's
guarantee,
true.
like,
People would
nine
sign
out of
up.
10 people are going to sign up for
Yeah,
sure.
yeah, yeah, that's true. And where do you see gold and precious metals play out in a society like that? Like as we move towards the future where there's green revolution comes online, where do you price silver and gold? Where do you see that?
Yeah, I mean, again, I think anything that's outside the system is probably it's not a bad idea to hedge that way.
Hmm.
So yeah, precious metals, that's a good, that's not certainly not a bad way to go. Silver, I'm not huge on. I like things I like gold just because it has a really big monetary premium. I mean,
Right.
sure, it has utility. I mean, you can use it in space, the space sector. You can use it in dental. You can use it. It has ornamental value, obviously, but it's a $13 trillion market cap gorilla. So, like, I think 90% of that is really like pure monetary premium. So that's what I like about gold. Silver is a little more on the utility side. I think it's given up a lot of its monetary premium to gold just because it's superior in some of these monetary properties. Scarcity is probably the biggest one.
Hmm.
Also more durable. I mean, if you dig up, if you find a pirate ship that sank in the Caribbean, 1,000 years ago, that gold it's untarnished. You can
Right,
you can
right.
use it same now as then. Silver, I think a little bit less so, but certainly it's less scarce. So I'm big on gold. And I think the other big advantage is just from a global macro perspective. Because of this flight out of the dollar, you're seeing a lot of central banks gobbling up. They're buying up gold at a record pace.
Yeah, they
So
are.
exactly. So I think if we can avoid another, which this time around I don't see it coming, but if we can avoid another executive order 6102 gold confiscation type of situation, then I think that can be a bad bet.
And there's a lot of talk about other countries like the BRICS countries, like you see China and Russia. They're trying to develop a kind of commodities backed currency that's partially backed by gold and certain commodities. Do you think that could ever be successful, Andrew? Could they ever pull that off to fight the dollar?
That's really interesting. I've been thinking about that a lot. I have to say, I kind of come down on the side of the guys at Santiago Capital,
Hmm.
that they're saying, we'll see it when we believe it. And I'm kind of in line with that, just because we are seeing a trend in that away from the dollar. So I think just like 20 years ago, foreign exchange reserves were at over 70%, and now 20 years later they're down at 59%. So you are seeing a trend away up. It's going to take decades, though.
Hmm.
But on the other side, you need a good alternative. And as bad as the dollar system is, but I just want to say this is not, an anti-U.S. type of thing. I think it's just
Right.
as bad for participants abroad as it is, and we can get into it, but it's terrible for Americans as well. So I don't think it's to anybody's advantage, really. But the alternatives, they're usually worse, unfortunately. So I mean, just if you just look at it in terms of pure money printing. So how much, is the currency being debased? How much of the economy and people's life saving is being sacrificed at the altar of fiat currency? And let's take the Chinese RMB, for example, as one of the biggest competitors.
Right.
They've been over the last 30 years, they've actually been printing at twice the rate of the U.S. And again, we mentioned the central banks. Debt to GDP is, at a staggering 213%. I don't think we've seen any major economy that is as indebted as the Chinese economy.
Right.
And when you're talking about, them setting up a competitor to the U.S., another way of looking at it is, to keep a Ponzi going, you want more and more people to buy in.
Right.
And that's what that is. Like, you're trying to suck in more participants so you can sort of leverage on top of their
Right.
economies. I mean, you, they're all sort of the same. I mean, you look at the euro, it's the same thing too. I think beginning of this year, they got Croatia to join it. They gave up their local currency, the kuna. They adopted the euro. Prices shot to the moon. Locals couldn't afford their groceries anymore. And the reason, of course, is that the euro kind of found a new sucker to buy in. Which,
Right.
if you just sort of play out the incentives, I don't know how much of an incentive there is for, Brazil or Russia or South Africa to jump from the frying pan into the fire.
Absolutely. Well, Andrew, it's been such a huge pleasure having you on Wall Street Silver. Like that was incredible. And hopefully as the market develops, we can have you back on in the next 2-3 months.
I'd love to. It was a pleasure. Ivan,
Yeah.
good speaking.
Yeah, it was a huge pleasure. Talk to you soon.